Hello everyone, I am pleased to welcome you to this webcast, which supports application of Section 11 Financial Instruments of the third edition of the IFRS for SMEs Accounting Standard. This is the second webcast in our series exploring the third edition of the standard. In this webcast, I will provide you with an overview of the main amendments to Section 11 in the third edition of the standard. The first change we're going to review is the new structure of Section 11. In the third edition of the standard, Section 11, Basic Financial Instruments, and Section 12, Other Financial Instruments, have been combined into a single Section 11, Financial Instruments. The new Section 11 is divided in two parts. Part 1 contains the requirements for basic financial instruments, such as simple bank loans. Part 2 contains the requirements for other financial instruments, which were previously in Section 12. Other financial instruments are more complex financial instruments, such as hedge instruments. Financial instruments that fall under Part 1 are measured at amortized cost or at cost, with some exceptions, whereas instruments that fall under Part 2 are measured at fair value, also with some exceptions. The second change we're going to review is the removal of the option to apply IAS 39. The previous editions of the standard included an option to apply the recognition and measurement requirements in IAS 39, often referred to as the fallback to IAS 39. IFRS 9 financial instruments replaced IAS 39 in 2018. After applying the alignment approach to IFRS 9, the IASB decided to remove the fallback to IAS 39. This means all entities applying the standard will only apply Section 11 in accounting for their financial instruments. This change will reduce costs for users of SMEs' financial statements. Entities that previously applied the fallback to IAS 39 will apply Section 11 retrospectively. The IASB has provided transition relief for derecognizing financial assets and liabilities, recognizing financial instruments in accordance with paragraphs 11.9 and 11.9ZA, treating fair value when it is impracticable to apply the effective interest method, and hedge accounting. Now, on to issued financial guarantee contracts. The IASB reviewed the requirements for these contracts after stakeholders noted that the requirements in the standard were more complex than those in IFRS 9. The third edition of the standard has been updated to include a definition for financial guarantee contracts, to require an entity to use Section 21 provisions and contingencies to account for financial guarantee contracts issued for nil consideration when the specified debtor is another entity within the group, and to include all other financial guarantee contracts in the scope of Part 2 of Section 11, which means they are measured at fair value. Including these contracts in the scope of Section 21 simplifies the requirements for SMEs, removing the complexities of measuring these contracts at fair value. Next, we'll look at the new supplementary principle to classify debt instruments. Stakeholders told the IASB that it can sometimes be difficult to decide how to classify a debt instrument. The standard previously included conditions for a debt instrument to be classified as a basic financial instrument and provided some examples of such debt instruments. These instruments were measured at amortized cost. In response to this feedback, the IASB added a supplementary principle to the standard to help with application. Paragraph 11.9 sets out the conditions for classifying debt instruments in Part 1 of Section 11. If it's unclear the debt instrument meets these conditions, SMEs can apply the supplementary principle. An SME, having considered the conditions and examples in Section 11, applies the principle that if the contractual terms of the debt instrument give rise to cash flows that are solely payments of principal and interest on the outstanding principal amount, the SME applies Part 1 of Section 11 and measures the debt instrument at amortized cost. The principle provides a clear rationale for classifying debt instrument when the debt instrument doesn't meet the condition in paragraph 11.9 of the standard or match the related examples. This decision tree illustrates how an SME applies the supplementary principle. First, is the debt instrument within the scope of Section 11? If it's not, the SME accounts for it in accordance with the applicable section of the standard. If the debt instrument is within the scope of Section 11, then the SME assesses the conditions in paragraph 11.9, including the related examples. Next, does the debt instrument meet the conditions in paragraph 11.9 and the supporting examples in paragraphs 11.9 to 11.10? If it does, then the SME applies Part 1 of Section 11 and measures the instrument at amortized cost. If the debt instrument does not meet the conditions in paragraph 11.9, then the SME assesses the supplementary principle in paragraph 11.9 ZA. Last, does the debt instrument satisfy the supplementary principle? If it does, then the SME applies Part 1 of Section 11 and measures the instrument at amortized cost. If the debt instrument does not satisfy the principle, then the SME applies Part 2 of Section 11 and measures the instrument at fair value through profit or loss, with exceptions. Next, we'll discuss disclosure requirements that have been added to Section 11. Section 11 now requires an SME to disclose an analysis of the age by reference to due date of trade receivables and other financial assets, and a maturity analysis for financial liabilities. This is an example of the disclosure of the analysis of age of trade receivables. You'll notice the age analysis shows separately the amortized cost of the financial asset before adjusting for any reduction for impairment or uncollectability, and the reduction for impairment or uncollectability. This is an example of the disclosure of the maturity analysis of the financial liabilities. You'll notice the maturity analysis shows the financial liabilities' remaining contractual maturities and the contractual undiscounted cash flows. The last changes we'll look at are those made to clarify or to relocate requirements and consequential changes made as a result of changes to other sections of the standard. Let's start with the requirement that was clarified. Section 11 now specifies that debt instruments that have prepayment features with negative compensation, that is, when the borrower compensates the lender for early termination of the contract, can still meet the criteria to be measured at amortized cost. Next are the two requirements that were relocated. Firstly, the application guidance on fair value measurement and disclosure requirements for fair value have been relocated to the new Section 12 fair value measurement. Secondly, the dividend income requirements have been relocated from the second edition's Section 23 revenue to the third edition's Section 11. Lastly, let's talk about the consequential changes. The initial measurement requirements of trade receivables have changed as a result of changes to the third edition's Section 23 revenue from contracts with customers. Section 11 now requires an SME to initially recognize trade receivables at the amount the SME determined in accordance with Section 23, unless the arrangement constitutes, in effect, a financing transaction, and the SME chooses not to apply the option in paragraph 23.38. Check out the upcoming webcast and educational module on Section 23 for more details on this topic. The scope of Section 11 has been updated as a result of the revised Section 19, Business Combinations and Goodwill. In the third edition's Section 11, the measurement requirements do not apply to contracts for contingent consideration in a business combination whose fair value cannot be measured reliably without undue cost or effort. Paragraph 19.27 applies to these contracts. Now that we've reviewed the changes to Section 11, let's look at what resources are available to support the transition to the third edition of the standard. The IASB published a project summary and feedback statement and effects analysis alongside the third edition of the standard. The IASB technical staff is updating the educational modules, prioritizing the sections with significant changes. These modules provide support to anyone learning about or applying the standard. The updated Module 11, covering Section 11, is now available. The IASB also publishes quarterly newsletters and a podcast series dedicated to the standard. The newsletter summarizes news, events, and other information related to the standard. The podcast offers bite-sized information to support implementation. Finally, you can submit implementation questions about the standard at any time. You'll find a link to submit questions on the Supporting Implementation page on the IFRS Foundation's website. We have reached the end of this webcast. Until the next webcast, thank you very much for watching and listening.